This conference will now be recorded.
Is that everyone are there online?
Yes, sir, your voice is audible.
Yeah, thank you, Ma. So in the last class, we have been seeing that how we can be able to do with the balance sheet calculation by using the Excel. So let me go with that. Hope you people have been understood with this calculation, how we have been done with. So we have been done till the balance sheet. How do you calculate with accumulated up depreciation values and the retained profit? So if I want to continue, I think yesterday I've been done till here. So now we are supposed to do with the net debt value calculation. So let me do this. Hope my screen is visible to everyone. So it was been done till here. So now let me do with the calculation of debt schedule. So if you people remember, how did we do with a calculation of installment? So do you remember? How did we do with the calculation of EMI calculation? So suppose
Yes,
if I
sir.
give the, yeah, good. So suppose if I'm going to give it over here, the same calculation, let me put it, copy this value. The loan period, let me put it for 1 year. And the value, let me keep it as 50,000. Okay. And the interest value is 15%. So can anyone help me out to calculate it? So let me take it, the period or the month. And this is the opening balance or beginning amount. Then what is the EMI? What is the interest amount? What is the principal amount? What is the ending amount? So this was the table what we had been created. Yes. So now for 1 year means it is going to be 12 months. Yes. Let me keep it till here. Yeah. So can anyone tell me that how do we do this calculation of EMI? Can anyone try? If you remember the previous sessions. At least EMI calculation. How do we do with EMI calculation? What is that function we are going to use it to calculate the EMI?
Sir,
Yeah, go ahead, ma'am.
is equal to PMT,
Okay, good. Is equal to PMT.
then rate 15%, comma
15%, comma,
1,
it is 1,
comma 50,000,
50,000,
and then 0
comma 0, future value 0, good,
and 0.
and 0, very good. But whatever the calculations you are going to do, whatever you did it now, so can you just imagine every month are you going to pay 57,500 for the principal is 50,000. So something good I appreciate with your you got it a right function to calculate it, but there should be some small changes over here. What was that? Whatever you have calculated, it was for annually. So we are supposed to do this as monthly. So I'll repeat it. So it is going to be, when you are going to calculate for monthly, so the rate of interest should be divided by the total months. So how many months make 1 year?
12 months, sir.
Yeah. Now the rate should be divided, but the the period is to be multiplied with the same period into 12. Okay. Now if I accept it, so this is going to be the EMI amount. So let me put it over here. Since the EMI amount it is in the negative figure, when I bring it in the EMI column over here, so I am supposed to bring it equals to minus, because minus into minus will make it as plus. Because why I am going to use it minus value means, if I calculate with this minus value, every value will become as a minus value. So the calculation will not be proper. So I will, for the sake of calculation, I am making it into positive value, that is equals to minus into this value. So it becomes positive. And this, it is going to be the same for all the months. By using F4, I'm going to make it as a fixed value, and this remains the same EMI till the end of the year. So can we just check it out? What is the total value? See, you are going to pay 54,155 rupees. Extra you are going to pay 4,155 rupees based on 15% for 1 year. Okay, and this EMI, it will be including interest plus principal amount. So how do we calculate this? So what is the beginning amount over here? What is the beginning amount? What is the amount you have taken to pay this EMI?
50,000.
50,000. Let me put this 50,000. Yes. So the next is, how do we calculate the interest? So it will be equals to the beginning amount of that period into what is the percentage? It is 15%. So, oh sorry, that 15% divided by 12. Yes. So out of 4,512 rupees, 625 rupees is going to be the interest amount. And the remaining amount, that is equals to EMI minus interest amount. This is going to be the principal amount. Is that clear till here?
Yes, sir.
Okay. So now the ending amount will be equals to the beginning amount minus the principal amount. So this will bring the end of the month. What is the amount you are supposed to clear it after paying the EMI? Now this beginning amount will be equal to the last ending amount of the previous month. Okay, and here I am supposed to calculate the interest amount as per equals that month's, that period's beginning period value into 15% divided by 12. Okay, and this will be equals to beginning amount, oh sorry, EMI amount minus interest amount, and ending amount will be that month's beginning amount minus principal amount. Okay, so you have to be very clear up to second EMI. So do the calculation properly till the second EMI. Then from the second EMI onwards, you can drag this and you can see at the end of the period, it is going to be 0. So is that clear? How to calculate the EMI value? Yeah, good. Thank you for the response. So now this calculations, whatever we did it, it is for monthly installment. The same thing if I am going to do it for the annually. So here it says to calculate equally annual installment, equated annual installment. Okay, whatever we did the calculation for the monthly basis. Okay, so let me put, so this was EMI calculation. Now what we are doing it is for EAI, that is equated annual installment. Suppose if you are supposed to be paid with annually, how do you calculate it? Okay, so here we are supposed to create the table in this way. So there we created in the column wise, here we are going to create it in the row wise. Okay, so how do we create or how do we calculate it in this ways? So always when you are calculating for the EAI, that is annual installment, you are going to start it with year 0. Year 0 onwards you are supposed to be started with. So here whatever you have the names, the headlines, headings. So BOP stands for beginning of period debt for that period. EAI is what the EMI or equated annual installment of that period, interest expenses of that period, principal paid of that period, and what is the end of period debt. Okay, so always start with year 0 end of period debt, because the loan whatever you are taking, so for that year there will be no payment. We are not going to pay that amount in whatever the year you are going to take it. You will pay it from the next year onwards. Okay, once after taking the EMI, I mean the loan, that amount will be started to pay from the next year onwards. So we are going to give the value for that year end. It is going to be the loan amount what you have been taken. So here the loan amount what we have been taken as per this information. Can anyone let me know what is the loan amount taken? Hope the screen is visible, and let me increase the font so that you can be able to have a clear values. Can anyone let me know what is the loan taken?
5 lakhs, sir.
Okay, so that 5 lakhs you are going to give it in the year 0 end of period. 5 lakhs. Okay, now as we know that the year starting, whatever the values you are going to give it, it is going to be the last year closing balance. So it should be equals to year previous year ending of period debt value, whatever the value is there, you are going to link it. Okay, you are not going to write it manually, you are just linking it from one cell value to another cell value, so that you can be able to do the calculations at faster way. Okay, so let me give it this value, beginning period value, as a last year's closing value. Next, EAI, how do we calculate? In the same way, PMT, give the rate of is 15%, let it be the same, comma, the period is for 4 years, comma, the value is 5 lakh, comma, future value is 0, comma, and it is for end of period 0, close the bracket. So it is going to show the value as 1,75,133, where this value it is in negative balance. So let us convert this negative balance into positive balance. So how to change this negative into positive? So we are going to start the formula, the PMT value itself, as negative. So negative into negative value will become as positive. Okay, so this is only for the purpose of calculation of debt schedule. We are going to change it from negative to positive, so that it can be calculated with the other values in a positive way. Okay, so now how do we calculate the interest expense? So equals to that year opening balance into the percentage, that is 15%. So 75,000. So equals to EAI minus interest expense. So this will become the principal repaid, and end of period debt value will be equals to the opening balance minus the principal repaid. So at the end of the financial year, it will be 3,99,867 rupees. Okay, at the year 1 ending date, the balance will remain as 3,99,867 rupees. So now, if I want to do this calculation for the second year, so I can do it the same, equals to the previous year's closing balance, and this will be the same value. This will be equals to that year balance into 15% equals to EAI minus interest expense equals to the opening balance minus principal repaid. So this is how the balance will be there. So instead of me doing it once again manually, I'll take this value, I'll just copy this value, and I'll just keep it over here so that I will keep it as a reference. Okay, so let me keep it. Okay, instead of me doing this manual calculation, let me drag it, or I can select it the other cells, and I can press Ctrl R so that it is going to feed up the calculated values on the right hand side, so that at the end of the period of fourth year, it is going to be zero balance. Okay, so can you compare with the year 2 value what it has been there when I dragged it and when I calculated? Is it the same values? Either if you do it manually the calculation, or if you drag it, is it coming with the same values? Is there any difference? Can you find it? Please have a look on both the values and let me know.
Different, sir. It's not sorry, it's the same, sir.
It's the same value, right? So that means if you people are very clear in the year 1 calculation, then till the end of the till the end of the period, the total period of tenure what you have taken, so till that period, if you drag it, so at the end of that period, it is going to be zero balance. So the debt ending period debt value will be zero. Okay, so if you have understood, can you try this with this case number 2 value? Okay, let me give it for 5 years so that it will be easy for you to do it. So can anyone try? So if few people start to try, it will be easy to me to convey the informations, convey the concepts. Even if it is a wrong, I can help you out, but at least I want someone to try it for the answer. How do we do the calculation of EAI? So from where should I start with, and how do I do the calculation? Anyone please try? Is there anyone? So in case if you are not understood, please let me know so that I can repeat it. So these are all the part of calculation, whatever we are going to discuss it in the practical. When we are going to talk about the projects. And these values are going to play a major role, so that you can see it now in the next balance sheet calculation. At least tell me to repeat or give me the answer. Start to tell the answer.
Sir, first year it's just 30 lakhs.
So is it year 1 or year 0?
Year 0.
In the year 0, in which heading I have to give this value now?
EOP debt, sir.
EOP debt. So that is end of period debt. Good. So I'll
Yes.
give it as 30 lakh. Yeah.
And then year 1 is the closing balance of year 0.
Okay. So
Equal.
the beginning period of year 1 will be equals to the value of year 0's ending balance. Right?
Equals PMT.
Equals PMT.
Rate is 10%.
10%.
Loan period 5.
Good.
30 lakh, comma 0 and 0.
Okay. Fine. So it is a negative value.
Minus. We have to
Minus.
multiply minus.
Okay. Please give me a minute of time. I'll be back. Yeah, sorry for the inconvenience. Yeah, go ahead, Ma. So we were doing it with EAI. So it is a negative value.
Multiply the negative, sir.
Okay, multiply with negative. So do you know how we can be able to bring it with that values? So how do I bring out that function what have been implemented in that cell by using
Uh,
what shortcut key?
to the next, freeze, sir, freeze. Function
That
F4.
is F4. That is F4. Actually, we are not freezing over here. We want to write it minus. Okay. So you have to bring that values, what you are used with the PMT, you have to bring it over there. You want to display the function what you have used it over there by using F2, function F2. Okay. So it will show what did you use it or to calculate that value. Okay, so here you have to bring it at the beginning of the formula. Enter. Good. That's good, right? Yeah. Next, go ahead, Ma. So how do we do the interest expense calculation?
To see the 30
Equals
lakh.
to, so
30 lakh.
30 lakh of
I
year
cannot see
ending or beginning?
the beginning, sir. Year one's
Beginning,
beginning.
yes, of that year beginning value. Good.
Into
Into
10%.
10%. Very good. Yes. So the principal repaid value will be
EAI equals
equals.
7,91,000. That's cell.
So EAI
Minus
value
minus the interest expense.
interest expense. Good. Next,
End
end of
loan
period.
equals is 30 lakh cell.
That is
Year one
beginning
beginning
value. Beginning value
principal repaid.
minus principal repaid. Okay. So this is how the calculation will be done. So should we do it for the year 2 also?
No, sir, we can use control R.
Okay, good. So we have to select first. If I want to get this calculated value on the other side, first we have to select all the cells which we want to implement it on the other cells, or copy the formula what we have applied on this cells and select it or drag it. Select and press Ctrl R or drag and see the values. So it is going to be with 0. Hope everyone have understood this. Okay, so I will forward this sheet so that please do this, the 7 years calculation, and you have to submit it by tomorrow. Okay, so I'll go to
Excuse
the
me, sir.
next. Yes, ma.
Sir, I have a doubt.
Good.
In my Excel, sir, whenever I change the dollar sign to rupee sign,
Uh-huh.
again it keeps getting changed to dollar back up, sir.
Okay. And
Yeah, and
what
also the
you can,
decimals.
okay, do one thing. Whenever you want to make a change, okay,
Okay.
so you can select that sheet. So you see
Okay,
at the
sir.
corner. So if I click
Yes,
on
sir.
this, it is going to get selected the whole sheet. So
Yes,
now
sir. Yes, sir.
you can go to this number
Okay.
and select with the currency.
Currency. Okay.
Okay. So
Okay, sir.
if you select with currency, you can get a list. Just a moment. Yeah. So currency, and make sure here it is going to show it the symbol as rupees. So if you
Okay,
click
sir.
over here, you'll get a list.
Okay, okay.
Okay. Suppose if you don't get it as a only rupee symbol, you can select
Okay.
Indian rupees. You'll get it as a Indian rupees or
Okay, sir.
English Indian rupees, anything related to rupee, you can select it and click on OK.
Okay, okay, sir.
Fine.
Okay, sir. Thank you, sir.
Okay, my welcome. Okay. So I'll leave it the 7 years calculation to you people. So let me go to the balance sheet. So here I have a data related to income statement by using these values. So in the last class also we had been used the same thing. So there are certain information over here. So the cost of machine, it is going to be 75 lakh, where that 75 lakh, it has been invested from the loan. The debt value is 75% and the equity value, it is 25% and the interest on the debt is 15%. So keeping all this value, I should be able to calculate this balance sheet values. So the cash value is already given. It is by default, it is there. So let us keep it the same values. So now I have to do this calculations. So what is PPE gross? PPE stands for PPE stands for
Plant,
yesterday
property,
we
and
have been
equipment.
power plant and equipment. Okay, so it is also an indication of an asset. So what is the asset value we have it? So what is the value of an asset? Is there anywhere given in the income statement? What is the value of an asset? So did anyone found out what is the value of an asset?
So is it 75 lakhs?
Yes, the cost of machine. Machine is an asset. So the value of an asset is 75 lakhs. Okay, and it is a year zero value. That means asset when it has been bought, it is 75 lakh. And what would be the asset value for the next year? In case, until and unless, if there is any new purchase of an asset, if there is any new purchase of an asset, the value will be added. But there is no information, anything that we have purchased something else as an asset. So it remains the same. So let me copy this information over here so that it will be there as a reference to the calculation. Yeah. So cost of the machine is 75 lakhs and the asset value will remain the same for all the years as same until and unless there is any kind of additional purchase of asset. Okay. So now what is the depreciation value? So how do we calculate the depreciation value? So what is the formula that we use to calculate the depreciation value?
Value of the asset divided by life of the asset.
Very good. So the depreciation value will be value of an asset is 75 lakhs divided by how many years? The lifespan of that machine is
Is it 4 years, sir?
yes. So here we have given only the 4 years data. That means it is only for 4 years. Good. Okay. So the depreciation value will be 18,75,000. So whether this depreciation value will be started from the year 0 or year 1 onwards.
Year 1, sir.
Year 1 onwards, because the depreciation will be calculated only once the machine is being used, an asset it is being used. Okay, so for the year 0 the depreciation will be 0, and for the year 1 it will be 18,75,000. Yes. Now here, when you are going to do the calculation of depreciation in the balance sheet, okay, it will not be only of that year depreciation. So which is called as accumulated depreciation. It has to carry forward the previous year's depreciation value for the current year. So that means equals to 18,75,000 plus what was the previous year value? What was the previous year depreciation value? The year 0 depreciation value is 0. So the previous, so you are going to calculate the current year depreciation value plus the previous year depreciation value. So what would be the next year? So it will be equals to 18,75,000 plus the previous year depreciation value. Then the third year it will be again equals to 18,75,000 plus the previous year depreciation value. Same way, equals to current year depreciation value plus previous year depreciation value. So by the end of the tenure, the period, it has to be the same value of an asset. Okay, so here we are going to calculate the value of an asset. So this will be equals to PP gross minus accumulated depreciation value. And this I will drag it till the end of the period and press Ctrl R, so that make sure that at the end of the period it should be zero value. Okay, so now it is asking us to calculate the total asset value. So how do we calculate the asset value? So it should be equals to the cash plus PPE net, because PPE net is the value which is calculated after calculation of PPE gross and depreciation value. So cash plus PPE net value we are supposed to calculate it. Okay, so now let's see the value of the assets, the total asset value, what it is going to be there for that financial year, for the last period. Is that clear till here? Is that clear to everyone? Yes, fine. So now, till now we have seen with the calculation of an asset. So let's see with the liabilities calculation. How does the liabilities calculation will be done? So in that first one is net debt. So here, what is the debt value to be entered? So the net debt value is going to be calculated based on the debt schedule. Okay, so let me keep it like this. So the net debt, the value whatever you have it in the liabilities, has to be calculated based on the debt schedule values. So how do we create this debt schedule value? Can anyone try to get me the answer which we tried just before? So it will be keep on repeating, so which will help us to understand the concept more and more on that part. So can anyone try? So what could be the debt value to be entered in the debt schedule so that I can calculate it? At least tell me what is the loan amount we have been taken in this case.
So 75% of 75 lakhs.
Yes, very good. So where should I give this value?
In the year zero end of payment debt.
Yes, end of period.
End of period debt.
Yeah. So equals to 75 lakhs into 75%. Very good. So which gives you the value of 56 lakh 25,000. So now this value has to be connected to
Year one beginning of period debt.
yes. So equals to give the connection with the previous year ending value and calculate the EAI So EI will be calculated with the formula of equals to, anyway we are supposed to give it minus symbol. So let me give it the minus symbol from now itself, minus PMT, open the bracket, give the rate of interest. So the rate is 15%, comma, N per value is, it is going to be totally 4 years,
Oh, you
yeah, comma, present value is 56,25,000, comma 0, comma 0, close the bracket, enter. So this is going to be the EAI for the year 1, and it remains the same for all the months, okay, for all the years, sorry. So interest expense will be equals to of that year into 15%, and the principal repaid will be EAI minus interest expense, and the end of period debt value will be beginning value minus principal repaid. So this is going to be the year 1 calculation. So I can drag it for the other month or year, so that it will calculate the last year's closing balance at 0 rupees. Okay, fine. So now, how do we connect this value over here? Okay, so here the net debt value, it should be connected from the debt schedule. So equals to connected with end of period debt value, because here it is year 0 it start, and I'm adding this value for the year 0 only. Okay, so please be very careful when you are going to prepare the balance sheet. It will be there from the year 0 onwards, whereas the income statement, it will be from year 1 onwards. Okay, so be careful in the calculations over here. Now next, this net debt value will be till the last of that year, so that it is going to be cleared. Okay, so this is how you are going to calculate it. The net debt value. So what will be the equity value? Equity value will be equals to 25%, and this remain the same for all the years. Okay, so hope you people have got a clear idea that the equity value will be same for all the period. So now the next one is retained profit. So what could be the retained profit to be entered? So how do we enter the retained profit? From where we can derive this value?
from the income statement.
Yes, from the income statement. So there is no year zero value from the income statement. So this remains as zero. From the second year onward, that is year one onwards, the earnings will start. Okay, so it will be equals to the income statements, the tax profit after tax, that amount should be connected, plus the previous year's profit. So you have to add it with the current year's profit plus previous year profit. So I'll repeat it, equals to the current year profit, that is 2,33,843, plus the previous year profit. So it is 1,84,703 equals to that year profit plus previous year profit, equals to that year's profit plus previous year profit. So like this, you are supposed to calculate it. Now, let me add the values. So total liabilities plus owner's equity will be equals to the sum of the net debt plus equity and plus profit. So here we have to add all these three values. So now if you drag it to the end, so now I'll do one checksum, that means equals to total asset value minus total liabilities plus owner's equity value should bring me 0. So let's check it out whether the balance sheet is balancing or not. Is that balance sheet has been balanced? With correct values, both total asset is equal to total liabilities plus owner's equity value.
Yes, sir, it is balanced.
It is balanced. So this is how you are going to prepare the balance sheet. Okay, fine. So now fine, we will consider this as a balance sheet contents, the concepts which I want to reach it to you. So we will wind up with balance sheet concept. Okay, I'll share this document to you. I want you people to be very clear with this debt schedule calculation. So which will be a definitely, it is going to be very important part when you're doing with the calculation. Okay, so please make sure that you are going to be clear with this calculation. Fine. Okay, so this is going to be ended with balance sheet concept. So the next financial statement what we are going to learn it is going to be cash flow statement. So the cash flow statement is a financial statement that summarizes the movement of cash and cash equivalents that come in and go out of a company. The cash flow statement measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. As one of the three main financial statements, the cash flow statement complements the balance sheet and the income statement. It is going to be interconnected to each and everything, like how we have been seen with the income statement connected with the balance sheet. The same thing, the cash flow statement also it is connected with the income statement value and balance statement value, balance sheet values. Okay, now when you are going to prepare the cash flow statement, it is being prepared under the structure of three important categories. So what are those categories is cash flow from operating activities, cash flow from investing activities, then cash flow from financing activities. So these are the three important things which will involve, and it will say that how the cash is been flowed into the organization. So let's see what all the things are involved in the operating activities. So the operating activities on the cash flow statement includes any sources and uses of cash from business activities. So otherwise, it reflects how much cash has been generated from a company's products or services. It's completely on the operational activities. So operations means what? The receipt from the sales of goods and services. So how much sales has happened? How much did we receive it? And whenever we have the purchase and sales transactions, so it will happen in two bases. One is the cash basis and credit basis. So here it is going to show that how much did you receive it, how much you are yet to receive it. Okay. The next thing is interest payments. So that is if you are paying any interest amount, income tax payments, that is the taxes, payments made to suppliers of goods and services, that is purchase payments, salary and wages payments to the employees, rent payment, or any kind of expenses which occurs in the operations. So all these informations we are supposed to put it in under operating activities. The next part is cash from investing activities. So on the investment, so that is when business is investing, includes any sources and uses of cash from company's investments. That is like purchase of a asset or sale of an asset, loans made to vendors or received from customers. So which is going to be a part of our investment. So we are going to take it and we are going to pay it later. Any payments related to mergers and acquisitions are included in this category. So if there is any changes in the value of equipment or assets value or investment value, so will be recorded under investing activities. So changes in cash from investing are usually considered as cash out items because cash is used to buy the new equipment, buildings, or short-term assets such as marketable securities. But when a company devests an assets, the transaction is considered as cash in. That is when you are going to sale of an asset. So that is considered as a cash in for calculating cash from investing. Okay. So the next category is cash from financing activities. So that means this includes the sources of cash, that is your capital also will be considered as a financial activities. So that is from investors or the banks, as well as the way cash is paid to shareholders. This includes any dividends. So if you are paying any dividends, you are going to show it over here. Payments for stock repurchases and repayment of debt. So when you are going to pay back your loans, so that are made by the company. Changes in cash from financing are cash in. when capital is raised and cash out when dividends are paid. Thus, if a company issues a bond to the public, the company receives cash financing. However, when interest is paid to bondholders, the company is reducing its cash. And remember, although interest is a cash out expense, it is reported as an operating activity, not as an financing activity. Okay, so these are the explanations what we have it on cash flow statement. So let us do one kind of a exercise so that you may get understood with this. Now, so now I have been given all these details. So you have to see on the left hand side and you have to bring it up the value on the right hand side table. So let me see that what all the things comes under what over here. So can anyone try?
Sir, we are not able to see your screen.
Okay. I'll reshare the screen a moment, ma'am. Okay, so let me give with a simple one. Yeah, hope the screen is visible now. Fine, I'll just try
Yes,
it
sir.
out from my side. So I'll do this one concept and I will forward this document to you people so you can try with the cash flow number 2. Okay, so fine. So the first one is cash received from customers. So where do we put this? Is it from operating activities? Is it on investment activities or as a financing activities? So when we receive any amount as our, when we make a sales of it. So customers will not pay us just like that. So we are going to receive the amount after when we make a sale. So whether it is going to be a part of operating or investment or financing.
So operating activities,
Yes. So I'll just bring up this value, copy, and I'll paste it over here. Okay, sorry. Copy and paste. So the value is 1,46,000. So let me put it in values manually, but be very sure that whether the amount is coming in or whether the amount is going out. When the amount is coming in, then you are supposed to put it in the positive numbers. In case the amount is going out of your hand, so in that case it has to be given in the negative amount. Okay, so here the amount is coming, so we are going to put it as 1,46,000. So it is the received amount to the business. Good. So the next one is cash paid for expenses. So whether this expenses will be considered as an operating or investing or financing. So expenses is anything you spend it to run your regular business. So that also will be a part of operating activities. So let me bring it over here. And when I say it is expenses, that is the company or the business is spending the money. Okay. So in that case, it is going to be minus 81,000. So the money is going out of our hand. So it is going to be shown in the negative balance. Then cash paid to suppliers. So whether it is going to be an operating or investment or financing activities.
operating activities,
So again, it is an operating activities, and whether the value is positive or negative.
negative.
Yes, because the money is going out of our hand. So 47,500 will be minus. So let me sum it up. Equals to sum of all these three values. So the value comes 17,500. So which is the cash flow from operating activities. So now what is next? Cash paid to acquire additional equipment. So whether it will be a part of operating, investment or financing.
So is it an investment activity?
Yes. So anything is going to be related to the asset, so that it is going to be shown in the investment activities. So whether you are going to buy an asset or you are going to sell an asset, so it is going to be shown on the investment activities. So let me give the value. Fine. Whether is it a positive value or negative value?
Negative.
Negative, because it has been paid. Cash is paid. So it is 20,300. Okay. Next, cash received from investor or investment of owner. So cash received from owner. So what is that amount we call it as? Yes, ma'am.
Investment.
So what do you mean by this? Cash received from investment of owner. What is the other name we can call it as? Anything, money comes as investment from the owner to their own business. So this is called as a capital. Okay. So the owner, what he brings to start the business is called as a capital. So what kind of activity it is? Operating, investment, or financing?
So is it a financing activity?
Yes. So when you are going to bring the money to run your business, it is called as in financing activities. So when you are going to bring the capital, you are going to put it into your business, and this value will be positive or negative.
It will be positive.
It will be positive. So that is 10,000. Yes. So the next one is cash received from bank loan.
Financing activity.
It's a financing activity, is good. And whether it is a positive or negative.
Positive.
Positive, because the money is coming to the business, it's a positive. Next, cash paid for bank loan as a partial payment. So when you are going to pay back the loan, see, for taking the loan, we consider it as a financing activity. And when we are going to pay back that same loan, even that also will be considered as a financing activity. That means it is reducing your liability, right?
Yes, sir.
Yeah. So is it a positive or negative?
It's negative.
It's a negative one. The next, cash paid to owner. So anything it is paid to the owner or it has been withdrawn by the owner. So what do we call that as? So anything you bring to the business by a owner, as the owner, what do we call that? The money what it has been brought to the business by the owner is called as
Capital.
capital. The same amount, if it has been withdrawn for their personal use, is called as drawings. So here it is going to be the same, and we have to give it in the financing activities. And this also will be negative value. Okay, fine. So how do we clear it? This is operating expenses. It is going to be related to your direct or indirect expenses and incomes. Your cash flow from investment activities, it will be related to the assets. Then cash flow from financing activities, it is going to be related to your capital and liabilities. Is that clear? Is there anything we have left out in the table? Yeah. So I think only these are the values what we had it. But we have something as a, if you had a cash, this is a cash opening balance. So we are not going to add the opening balance anywhere over here. So first we will calculate all this value. So in the operating balance, we have a 17,500 positive. In the investment activities, we have the value is only one value we have it, that is negative minus 20,300. So the total of financing activities, it will be equals to sum of all these values. So it is 13,000 positive value what we have it. So the grand total is, that is net change in cash flow. It should be the total of all these three activities. So that is equals to the operating activities value plus investment activities value plus financing activities value. So this brings 10,200 rupees as your current cash flow, what you have it right now. Okay. So that is the cash what you have it right now in your hand, 10,200. So here it says, if you had a cash as on 1st of April as an opening balance as 10,800, then what is the cash balance as on 31st March 2021? So what will be the cash balance as on 31st March?
The current year balance 10,200 plus the opening balance 10,800.
Yes. So it will be 10,200 plus 10,800. So that is 21,000 will be the closing balance. Okay. So this is how we are going to do it with cash flow statement calculation. Fine. So I'll be forwarding this and the balance sheet debt calculation sheet also in the WhatsApp group. Please follow with that, and I want you people to prepare with this cash flow statement at least by day after tomorrow. That is, next class is on Friday, I think on Thursday. Sorry, on Friday, right?
Yes, sir. It's on Friday.
It's on Friday. So by that time, I want you people to feed it up with both of this sheets, that is the cash flow statement as well as balance sheet debt schedule. So by Friday afternoon 4 o'clock, I want you people to finish it up and upload it. Even if it is before also, it's okay. Okay. Thank you all. Have a nice day.
Thank you, sir.
Thank you.
Thank you, sir.